The ABCs, property management, and advance. Advances are the finance strategies. The property management is the key. And then the ABCs are the basics. So you invest in that, you'll make a lot more money than going back to college.
The housing market in U.S. is a hot topic right now. The Federal Reserve Bank of Dallas made headlines in recent weeks after warning that there are signs of a brewing U.S. housing bubble. That prospect sparks fear in anyone who remembers or felt the impacts of the housing market crash that hit America during the 2008 financial crisis and subsequent Great Recession. And now many people are asking the obvious question: are we in a housing bubble much like 2008? And will the housing market crash or at least deflate at any point in the near future?
Wow, this is crazy for the housing market crash. The Federal Reserve just released a report that consumers are now expecting mortgage rates to skyrocket. Take a look at this expectation right here. Households expect the 30-year fixed-rate mortgage to rise sharply in the future to 6.7% on average a year from now and 8.2% in 3 years. People are also getting discouraged. The average renter now reports the odds of owning a home at 43.3% in the next year. That's the lowest read ever in the history of this New York Fed report, and it's down from 51.6% a year ago. Now, in my opinion, somebody's got to be wrong here. If rates go to 8.2%, that would be a full 5.5% higher than where we were at the end of December, which is a removal of 55% of buyers' purchasing power, and there's no way prices go up in that sort of environment.
Hello and welcome to Wealthy Value. In today's video, we will discuss all the new developments in the housing market, why the housing prices have started dropping, and what do the experts predict will happen next. If you liked the video, don't forget to give it a thumbs up, subscribe to the channel, and turn on the post notifications. Let's dive right into the video.
Yeah, well, first of all, remember, as far as the CPI, the government claims that housing costs are only up about 5% year over year, which is incidentally the most that they've claimed, in a while, I think, but the actual increase is more like 15 to 20%. That's part of the fraud of the CPI. They don't use actual rents or actual home prices. They use owner's equivalent rent. Well, nobody pays owner's equivalent rent. They pay real rent, and the real rents are going up triple what the government claims. So housing is a much bigger issue and rents than the government admits. But yes, housing is essential. People do need a place to live. But the question is, how big a place and how many people can share one dwelling. So, there is going to be a problem with real estate, certainly in the inner cities or, big cities, urban areas where people, don't have to, go to work anymore. They can work from home. People want more space. They want more land. Maybe they want to grow some vegetables on it. I don't know. But I think so. Real estate is going to be a mixed bag because mortgage rates are going up, and that's going to be a big problem. In fact, we're now over 5%, which may not seem that high historically, but when you have historically high prices and rates were close to 3% and now they're over 5%, that makes a huge deal. And of course, the construction costs for new homes are going through the roof. So we can't supply new homes into the market because they're too expensive to build. So you're kind of stuck with the inventory that's already there. So that would, keep home prices propped up.
The housing crash that began in 2007 is widely considered the most violent in U.S. history and is a reference point for many people watching housing prices skyrocket today. The 2007 crash is still debated to this day, and while we won't try to pull apart all of the moving pieces, there are some important differences between then and what's happening now. American real estate agent turned YouTube personality and influencer Graham Stephan has also summarized the whole housing market outlook in detail.
First, the March 2020 interest rate reduction allowed homeowners to lower their monthly payments while simultaneously giving them more purchasing power at the exact same time, thereby causing prices to go up. Second, the shutdown resulted in a record low number of homes on the market, and with a severely reduced supply, that leftover inventory was bid to an even higher amount. Third, supply chain bottlenecks meant that housing materials took longer to arrive, they were more expensive, and consequently that cost gets passed on to the consumer, which, you guessed it, causes even higher prices. And fourth, labor shortages also fed into the overall cost of housing, because with fewer people available to do the work, they either charged more for their time or fewer homes were built, leading of course to less inventory. All of that happening at the exact same time led to a very unique situation where housing prices rose to their fastest level in, well, pretty much ever. But that could soon be coming to an end, because for the first time in a a very long time, we're beginning to see a new shift in the market, and here's what's being discussed. Throughout the last few weeks, the Federal Reserve has been on a mission to raise interest rates and halt bond buying in an effort to combat high inflation. But the very obvious and very quick consequence of that is higher interest rates for everybody on everything. In fact, mortgage rates have risen at their fastest pace in 30 years, and the expectation is that they're about to go even higher. Much, much higher.
So are we really in a housing bubble, or it's just a misconception?
Bubble. Now, first of all, it's important to recognize that just because something goes up in price doesn't automatically make it a bubble. After all, there is an element of supply and demand, increased cost, and a local job market that could positively influence prices higher. But in this case, the Dallas Federal Reserve has warned that the housing market has diverged from market fundamentals, where there is widespread belief that today's robust price increases will continue. Or in other words, when a buyer purchases a home only because they believe that prices will go even higher, that is a sign of irrational exuberance, and that is the issue that we're seeing today in the market. As they say, this can continue pushing prices beyond their fundamentals until investors become cautious, policymakers intervene, the flow of money into housing dries up, and a housing correction or even a bust occurs. So to look for a tipping point, they search for signs where housing prices have exceeded what economic fundamentals could justify, and what they found was quite surprising. They show that from 1999 through 2008, the market experienced irrational exuberance, just like it's showing now from 2020 until who knows how long. Of course, this data means absolutely nothing without the analysis behind it, so to call it a bubble, they look for an imbalance between the rental to home ownership costs along with price to income to determine whether or not we're in this irrational exuberance phase. And the answer is yes, kind of.
Even though the report called the current housing market abnormal, the authors concluded that there is no expectation that fallout from a housing correction would be comparable to the 2007-2009 crisis in terms of its magnitude.
Now, I know some people like to say, oh, but rates used to be 8% back in the 80s. It was fine then. Yeah, well, home values were also substantially less expensive. The median price for a home was about $100,000. Today, it's over 4x that, and we just came off a rate sitting around 2.8% at the end of last year, setting a lot of high real estate comps. Higher mortgage rates, especially if we start crossing the 6% threshold, bad.
Alright, so now in terms of what the experts believe is going to happen within the housing market, first, they believe that millennials and Gen Z are going to keep the market strong. They reported that most first-time home buyers are under the age of 40, which means the buyer pool is deep and demand will likely remain elevated. Not to mention, housing inventory has been on a steady decline since the early 1990s, so the chance of more homes getting built is probably not going to happen anytime soon. Second, supply can't keep up with demand. They say that supply-demand imbalance is the primary reason home prices have escalated so rapidly. And after not building nearly enough homes for over a decade, it'll take home builders several more years at least to add more supply to the market. Third, unlike 2008, buyers are a lot less likely to default on their mortgage. Today it was found that more than 76% of mortgages go to buyers with a credit score exceeding 760. Lending standards have increased and homeowner equity is at a record high. This means that the chance of a foreclosure or an underwater loan is relatively slim. And even if the market does decline, homeowners are not going to be forced to sell. Fourth, a declining economy could affect the housing market. They mentioned that rising interest rates could put a damper on consumer spending, which increases the likelihood of a recession. Energy and commodity prices from the ongoing crisis with Russia-Ukraine could also have an impact, while consumer confidence drops to a 10-year low. And fifth, most predictions indicate that housing prices will continue to rise, but at a slower pace. For instance, the Mortgage Bankers Association predicts a 4.8% increase throughout 2022. CoreLogic expects a 6% increase, and Realtor.com predicts a 2.9% increase. Now granted, inflation could very well be higher than those numbers, so we might actually see a net decline. But regardless, these levels appear to stay, even though interest rates are expected to continue going up.
In 2022, almost all American households have rebuilt their nominal net worth to pre-recession values. Although the pandemic threw the economy for a loop, the labor market has recovered 93% of its lost jobs, and the unemployment rate now sits at just 3.6%. Lending standards have also tightened and home values have rebounded to record highs, which is why some experts believe the housing market is in a far better position than it was in 2008. While there are some similarities to the mid-2000s housing boom, the key difference is the type of buyer in today's market. One of the big differences is home buyer quality. Last cycle, anyone could get a mortgage. This cycle, we have far more stringent lending rules.
Now, at the end of the day, as long as you don't intend to sell your house in the next 7 to 10 years, it's probably a good idea to stay patient, wait for the right house, and don't pay more than what your budget can support.
So what do you think? Will we witness another housing crash anytime soon or not? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.